Types of business organizations. There are four types of business organizations: sole proprietorships, partnerships, corporations, and limited liabilities companies. A sole proprietorship consists of one individual doing business. This form of business organization is the most numerous in the United States. The first advantage of this type of organization is that the process is simple and inexpensive. This type of business organization can only be started by an individual business owner. Fewer regulations and no corporate income taxes. All profits made are reported on the business owner's personal tax return as personal income. The fourth disadvantage is unlimited liability. Owners are personally responsible for the obligations of the business as well as for actions of any employee in the business. Limited life. A sole proprietorship can exist as long as its owner is alive and desires to continue the business. Difficulties to raise capital. Usually funding is in the form of personal savings or personal loans. Documents needed to form a sole proprietorship. If you're planning to have a service company without employees, for example, a consultant, the only registration form you'll need to fill out is doing business as DBA. In some states, sole proprietorships have to be registered with the state government or the county clerk office. Driver's license or your state ID card will be required to register. For service business with employees, you'll need a DBA license and an employer identification number obtained from the federal government. For sales business, a DBA and an employer identification number are required, as well as a seller's permit if you're selling products. Applying for the permit has to be done at least 3 weeks before opening business. The document needed is a state ID card or driver's license with the application. The documents needed for a restaurant are a DBA registered with your state government, EIN from the IRS, seller's permit to collect sales taxes from customers, and food service license. A partnership may consist of two individuals or have dozens of partners. There are different types of partnerships: general partnership, limited partnership, and limited liability partnership. General partnership is when business owners are personally liable for business lawsuits and debt. For limited liability partnership and limited partnership, the business owners are not personally liable for business lawsuits and debt. The first advantage of partnership is that it's easy and inexpensive to form. Partners combine their resources together and share all financial burdens of operating the business. Partnerships may be subject to fewer regulations than corporations. No corporate income taxes. The income is reported on each partner's personal income tax return. The first disadvantage is unlimited liability. There is a personal risk for general partners who are individually responsible for the obligations of the business. Limited life. Withdrawal or death of a partner may end a partnership. A partnership agreement is needed on the chance of conflicts between partners that could lead to dissolving the partnership. Documents needed. Trade name application. A partnership may use the surnames of the individual partners or may use a fictitious business name. A partnership must file a trade name with the county or city clerk's office. Form SS4. Partnerships must file Form SS4 with the Internal Revenue Service. Form SS4 is used to get an employer identification number or a federal tax ID number from the IRS. A partnership agreement that indicates rules and regulations for operating the business is one of the most important documents when forming a partnership. It states the roles and responsibilities of each partner, the financial contribution made by each partner, and how the company will distribute profits and losses. Depending on the types of business activity, obtaining licenses, permits, and zoning clearance may be needed. A corporation is a legal entity doing business and is distinct from the individuals within the entity. The first advantage of this type of organization is unlimited commercial life. The corporation does not dissolve when ownership changes. Potential in raising capital through the sale of stock. And limited liability. Individual owners in corporations have limits on their personal liability. Even if a corporation is sued for millions of dollars, the value of shareholders' owned stocks are the only liability they have in the corporation. The first disadvantage is regulatory restrictions. Corporations are more closely monitored by governmental agencies, including federal, state, and local. Higher organizational and operational costs can contribute to budgetary challenges. Double taxation arises when companies pay taxes on the net income of the corporation through their corporate income tax returns. There are two types of corporations, C corporations and S corporations. A C corporation is double taxed, and the corporation pays taxes as do the company's shareholders. S corporations are single taxed. All taxation and business expenses are paid for by the company's shareholders. S corporations are limited to a maximum of 100 shareholders. A C corporation can have unlimited shareholders. Members of S or C corporation are not personally liable for lawsuits and debts. When your business is structured as a corporation, it's easier to attract investors for your business. Documents needed. Articles of Corporation is the document necessary to form a corporation. Articles of incorporation are filed with the Secretary or Department of State. Corporate records book has to be set up with all of the corporation's important papers, including minutes of director and shareholder meetings, stock certificates, and stock certificate stubs. Corporate bylaws. This document includes the basic ground rules for operating a corporation. It isn't filed with the state and not legally required to have. Registered agent. Every corporation must have an agent for service of process. The name and address of a corporation's registered agent must be contained in the articles of incorporation. Agents must reside in the state where corporation is located. A corporation must obtain a federal employer identification number. If a corporation wants to have S corporation status for tax purposes, it must submit Form 2553 election by Small Business Corporation. Corporation may need to obtain other local and state business licenses depending on its type of business. Limited liability company. There are two management options for establishing a limited liability company: member managed and manager managed. I'll review advantages and disadvantages of each of these options. A member managed LLC has a single level structure. All members participate and share responsibilities for the day-to-day running of the company. It means everyone can sign LLC checks, negotiate on behalf of the LLC, can take out loans, buy and sell assets in the name of the LLC. LLC's income is declared on the owner's individual income tax return. It's easy to monitor business activity when a company has only one or two people who are running the business, but if LLC has 10 people in it who act independently, managing is becoming very difficult. A manager-managed LLC has two-layer structure. Only people or businesses who are named as managers can operate the business. A manager-managed LLC is preferable when the business is too large and complex, or when some of the members are not skilled at management, or when you want your LLC includes silent partners who wish to invest and own a part of the LLC but do not take part in the day-to-day decision-making. Manager-managed LLC has limited liability and low tax rates. The only disadvantage is creating a detailed operating agreement where you clearly address what authority and responsibilities managers will have. Without an agreement, your state's LLC rules will apply, which are not necessarily the rules that you want for your business. Documents needed. Articles of organization is simple document that is required by all states. The form includes basic business information such as name, address, member names. Operating agreement. Although not required by most states, an operating agreement is an important document that structures an LLC's financial and functional decisions. It is recommended to create one to protect yourself and interests of your business. Licenses that are required for your type of business and other regulatory requirements. Determine other compliance obligations. For example, your company may be subject to environmental laws, federal import or export laws, state labor laws, etc. And obtaining employer identification number. Thank you for watching.